Hello, hello, hello. I'm back. So I've been away from YouTube for quite a while, actually. I had to take time off to sort out quite a few things. I had a few personal things I had to sort out. I had robots that I was creating that I needed to focus on. I had a few funded accounts that I was working on. I had other personal issues that I needed to sort out and organize before I could continue uploading videos because, believe it or not, this actually takes time. So now that I'm done with most of all that, I'm back and I have lots of goodies for you. We have a lot of things to discuss, things that will help both newbie traders and experienced traders on their journey. I have a lot of insight and knowledge to share based on my 13 years trading. All the mistakes I've made, all the things I've learned, all the tips that have helped me, all the things I've put in place to ensure that my account grows and my equity curve is consistent and smooth. But today we will be talking about stacking trades. Now, for those that don't know what stacking is in trading, it's basically adding to existing trades. That's basically it in a nutshell. It's adding to existing trades. Let's go to the charts so I can better explain. Okay, so let's say I was about, okay, so let's say I looked at the chart here and I looked left. Let's say I was at this point. Let's say I was at this point where this vertical line is. So let's say I hadn't seen all this data to the right of this vertical line. And let's say I looked left and I saw that price went up, bounced, went up, bounced, went up again, and bounced back down. So it occurred to me, it looks like price is actually bouncing at this resistance, what we call resistance, which is basically a line above, or rather a region above, an area above, where price doesn't seem to go past. Now, it seems price is bouncing off this region here. So what I'm going to do is I'm going to wait for price to go back there again and then see what it does. And then hopefully go in for a sell trade. Okay, so I then look at, I wait for price to come this way, and then it goes up all the way up here. Let me delete this vertical. Goes all the way up here and then paints this massive big bar down that ends here, that closes here. At that point, it occurs to me, wow, it looks like price is really going to go down. Now, this is not a strategy. This is just for illustration purposes. And of course, it is with hindsight. So everything that we do now in this example is going to work because it's with hindsight. Okay, so it occurs to me, wow, this is really going to work. It's going to go down. Price is going to go down. So what I do is I enter a sell trade for, let's say, one lot at this point, expecting it to go down so I can close my trading profit. And I put my stop loss maybe somewhere around here. Okay, and then it goes down, prints this bar, and that confirms to me, yes, I was right. Price is going down. And then it starts to go up. It starts to retrace up again, but it starts to retrace in smaller bars. And then it gets to this point. At this point, I look left again and realize that there was some sort of level of resistance here, which it might bounce off again. Okay, so I wait for the next bar. The next bar forms a downward bar, a bearish bar. And that confirms to me again that it will continue going down. So at that point, I tell myself, okay, I can add another one lot to this trade. So I add another one lot here, expecting all of them to go down and make me huge profit. Okay. And then it keeps going down. And I'm like, wow, I am amazing at trading. So it gets past this support area and closes below this support area on this bar. At that point, I tell myself, this is going really well. So I enter another trade there. I enter a one lot. So these are 3 one lots now. 1, 2, and 3. And then price goes all the way down and closes, or rather, and reaches this point, at which point I close the trade. Now, of course, this is a perfect trade because it's in hindsight. Now, what has happened here? I entered one lot at the top here, entered one lot here, entered one lot here, and closed everything at the bottom here. That has given me a lot of profit because I normally would enter with just one lot at the top without entering these other 2 lots here. Okay? Now, that's all well and good if price always went in our favor. That would be amazing. However, that rarely happens often. What tends to happen is price takes us in the first trade. It goes up, it bounces, comes here, and then sometimes goes back up and takes us out. Or it takes us in the first trade, comes down, bounces up, goes down to this point, sees resistance, sees support here, and then stays here for a while and then bounces back up. So, but once in a while, we have trades like this that just go in our favor all day. And that's amazing. Okay, so that's what we just did here, was to stack trades. It's basically stacking one trade on top of the other, adding to existing positions. And some traders trade like that. Some traders don't. Now, why should you and why should you not trade like this? Okay, now, if you are a newbie trader, what I usually advise, for example, what I tell my students is do not stack, especially when you're just starting out. Do not stack. Because 1, you do not need to stack to be able to make profit. You do not need to stack your trades to be able to make profit. Because stacking of trades, yes, it has the potential to give you more profit, but it also has the potential to make to make your trades go into huge loss, and it could actually wipe your account out. You could actually blow your account as a result of stacking. I have seen many people blow their account. I've seen many traders blow their account as a result of stacking because they are not considering the risk involved. Okay, so if you're just starting out, do not stack because stacking requires some level of skill and to some extent discipline and experience. Okay, however, if you're the type that stacks, there are a couple of ways to do it that reduces the risk. Okay, back to the charts. Now, what you could do, which is what I sometimes do, I'm not a huge stacker. It depends on the strategy. So I trade quite a few strategies, and some of them are suitable for stacking, some of them are not. But for the ones that I stack in, what I tend to do is I take the first trade here, and then I wait till it gets, or rather, I wait till price bounces off, goes up and bounces off, gives me confirmation that it's going to go down. However, I tend to wait till it comes here, breaks this level of support, closes below the level of support on this bar, and then I enter another trade here. But as I'm entering that trade, I am moving this trade here to break even. So the stop loss is no longer here. I will move the stop loss here. So if price goes up to take me out, it will take me out at break even on this trade, but I will have a loss on this second trade because the stop loss of the second trade will be where the break even of this first trade is. And if I'm going to keep entering stacked trades further down, I am going to do the exact same thing that I'm doing here. So at each point in time, I only run the risk of losing just one trade. Whereas I will, because I am moving these previous trades to break even, I will be gaining, I'll be gaining profit on those trades. So if price goes back up to take me out, I would have gained profit on previous trades but lost on the current trade. That will either result in me being break even for that total move, or being net up for that total move. Okay, so I do that. There's also another method I use, which is basically not moving them to break even. However, I split my expected risk over a few trades. For example, let's say I haven't taken this trade. Let's say I haven't taken, so let's say I have just this one trade on, and I have my stop loss here. Rather than entering one lot, what I would do is I would enter 0.3 lots or 0.33 lots here. Okay, and then when price goes up and comes down, I will enter another 0.3 lots here. Now I'm calling it 0.3 lots just to make it easy, because normally it wouldn't be the same lot size as the first lot size, because we need to calculate based on the stop loss. For example, if I'm entering here, I might put my stop loss here. So from here to here should be 0.33 of my expected total risk. Same way, from here, the first trade, to here should be 0.33 of my expected total risk. But for simplicity, I'll just say 0.33 lots. Okay, so I'll enter that here, and then if I, for some reason, was going to stack again here, I will make my risk here 0.33. So at the end of the day, what I am risking is actually one lot for the whole move. So I'm not risking more than I normally should. Okay, and then in that case, I can decide whether I'm going to move these to break even or not. But even if I don't move them to break even and price goes back to take me out on all trades, I will be out for the same one lot, or the same one lot on that total move. Okay, so that's what those are the two ways I tend to stack trades. When I stack trades, like I said, I'm not a big fan of stacking trades, because even when you're cautious in stacking using the two methods I've just shown you, you are still exposing yourself to more risk than you normally would expose yourself to. For example, if you only decided to trade one lot and price moved in your favor, and you decided to move your stop loss to break even, and price then retraced back up to take you out, you will be taken out at break even. You would not make any loss. However, if you stack, even in the safest way, if you stack, the first trade will be taken out at break even, but the second trade will be taken out at a loss, which means rather than being break even for the day, you are now at a loss. Okay, so there's still an element of risk involved in stacking, which is partly why I advise newbies not to stack. Okay, now what are the reasons people stack? They stack because traders stack simply because they want to make more money from the same move. Because yes, trading 3 lots as against 1 lot, of course, will give you more money, will make you more profit. However, if it goes against you, that's a different story. Another reason is, like I explained to you in the second method, they sometimes want to be sure that the market is going in their favor before adding a full size, or adding a full lot. In some way, that is actually minimizing your risk. However, still, it introduces an added risk when you've added your full size. And I'll explain that to you. Back to the charts. If you decided, let's say you hadn't entered these trades. So you had only entered this one trade. But rather than entering, like I explained before, rather than entering one lot, you decided to test the market by entering 0.33 lots. And then price went down, which confirmed to you that, oh, it's going in my favor. And then it went back, it retraced back up, and then closed back down here. At this point, you might decide to enter the rest of the lot size to make up one lot, because price seems to be confirming to you that it is going in your favor. Okay, now what that has done is it's helped you wait for the market to show its hand. It's helped you wait for the market to show you that it's actually going down before putting a full lot. However, it's the market. It can still reverse at this point and go back up and take you out. So that's why I always say think risk. Think risk. Never think of what you're going to gain, what profit you're going to make when price gets to the bottom here. No, that's not what you should be thinking of before you put on the trade. What you should be thinking of before you put on the trade is what will happen if price reverses against me and takes me out after I've put in all my stacked trades. That's what you should be thinking of. And then after you've mitigated your losses and after you've done your analysis and put on your, or rather, after you've done your analysis, you can then ask yourself, okay, so what am I going to make? What am I going to make if price goes in my favor? Okay, but it is risk first. We're not here to make £1 million in a day. We're here to grow our account and become wealthier over time. We're here to grow our account steadily and become wealthier over time without blowing our account, without blowing our life savings. That's what we're here for. We're here to be responsible in our trading. Now, one very important thing that I haven't heard anyone talk about is ensuring that your stacked trades are treated as a separate strategy, or they're treated as a separate trade, a trade on its own. I'll give you an example. Now, if we take a look at this, let's remove this second trade. This first trade would be the trade that you would normally take if you were not stacking. However, when you go to enter a second trade at this point, you're hoping that it will go down and make you profit on both trades. But before you start to place stacked trades like this, you need to back test. Hopefully, you've back tested your original strategy, which is this trade, and you've proven that it is profitable. Okay. However, you need to back test this second entry as if it was an entry on its own, as if you did not have this first trade in place. And I say so because if you backtest this second entry over, say, 1 year, and you realize that every time you realize that entering a second time, or rather entering a stacked trade over a period of 1 year leads to a net loss, then it is pointless to stack a second trade on top of your first trade, because it means you are reducing the profits that you would get by not stacking at all. So when you stack, or when you decide to stack, ensure that each stack is treated as a trade on its own. It's treated as a strategy on its own, and each strategy should be profitable for you to trade it. So if I'm going to be stacking once and stacking a second time here, this on its own should be profitable over a long period of time. This on its own should be profitable over a long period of time. Only when you have done this, you've done an analysis like this, can you decide to start stacking. And only then will you be profitable in your stacking. If not, your equity curve is just going to be up and down all over the place, because you have no proof, you have no data backing your stacking. You might have data backing your original strategy, which is the first trade, but you don't have any data backing your actual stacking. in which case you should not be stacking in the first place. Do not be stacking. Do not trade what you don't have data backing, because you should always think risk. Always think risk. If traders were to always think risk, you wouldn't, the percentage, the stats would not be as abysmal as 95% to 97% failing in Forex. It's because most people are in a hurry to make money. And interestingly, the more you are in a hurry to make money, the slower it will be for you to make that money. So, as I said, think risk. When you're entering a trade, think risk. When you're entering a stacked trade, think risk. When you're backtesting your strategy, think risk. Always think risk. And that's it for today. If you've enjoyed this video, do the usual. Click all the clickables. Like, share, subscribe. And until next time, be safe in the market.